Hello, colleagues. Welcome to Mathyard Institute, an online tutoring platform that helps simplify university for you. Okay, so today we are going to look at cash flow statements. What is a cash flow statement? Okay, so in the simplest form, we will define a cash flow statement as basically as a statement that shows the movement or the movement changes in the cash flow or the cash of a business. What are we saying? The movement of cash in and out of the entity, when you put it in a statement, becomes a cash flow statement. So basically, you are just trying to elaborate that this money came in and this money went out, and at the end of the accounting period, this is the money that remained. Is it a positive amount or is it a negative amount? Did we end without cash or we ended with certain amounts of cash? Basically, that is a cash flow statement. Now, talking about cash flow statements, what are features? What are the prominent features that you always find in the cash flow? So there are three activities that have to be there for it to be a fully qualified cash flow. Operating activities, investing activities, financing activities. Okay, basically that's what we are talking about. These three are the components or the primary components of a cash flow. So if you are able to identify any cash transaction that has occurred as a result of an operating activity and a cash transaction that has occurred as a result of an investment activity and a cash transaction that has occurred as a result of a financing activity, then you are good to go. So under cash flow, the basis, as we had earlier stated, the basis is just to identify, to say, this transaction, is it a cash transaction? If it is not a cash transaction, ignore it. If it is a cash transaction, you then ask yourself, if it is a cash transaction, was the cash, or what effect does it have on the cash? Huh? Are we together? If it's a cash transaction, what effect does it have on the actual cash of the entity? As a result of that particular transaction, does money come into the company or go out? Okay? Does the money come into the company or it actually goes out as a result of that cash transaction? So if the money is going out, then you know that that is a cash outflow. If it's going out. If it's coming in, then that's a cash inflow. Okay, and now you've also established another very important aspect. The first aspect was to identify, is it an investment activity? Is it a financing activity? Is it an operating activity? Secondly, what is the effect of this transaction on the cash account, on your cash? What happens to your cash when this transaction happens? Okay, then you establish that the money comes in. Oh, okay, the money goes out. After establishing that, you would have created the base for your cash flow statement. Actually, even from here, you would have been guaranteed that you have solved 50% of your problems. Okay, now it is not just solving 50% of your problems, it's solving 100% of your problems. So that is the reason why we are forging ahead. Now, uh, when you see a transaction, and we'll take for instance, you have, what kind of an example will I give? You have purchased equipment for 40,000 US dollars. You have purchased equipment for $40,000. Okay, for cash. Let me emphasize, because you can purchase for a bond or for shares. Now you have purchased an equipment for cash costing 40,000. Now, let us look at certain important things from just this statement. Is it a 5 or 6 worded sentence? Purchased, one, equipment, two, for cash, three. Okay? You've purchased equipment for cash. Purchased. Let's not even go into deep terminology. Purchase, when you are purchasing, what does purchase mean? Okay, you are buying a cup, you are buying vegetables. When you purchase an item, basically you are paying off. You are removing money from your entity or from your pocket as an individual out. So now you ask yourself now here, under purchase, this statement, what does it mean on the cash inflow or outflow, on the cash flow? So you know that you are removing money out of your pocket or out of the business. So that means this is a cash outflow. Cash outflow, it means you've removed money. So what happens to the account, cash account? It reduces. So meaning the answer you are going to get, this 40, will be in brackets. Why? Because you've purchased. And purchasing is removing money. And removing money is a cash outflow. And a cash outflow denotes a reduction in your cash account. Hence, you reduce it, you less it from your cash account. Now, there are these activities, the 3 activities that are there. So where do you less it from? You know that equipment is what you use to produce or to actually get your daily business working. Equipment is not your stock unless you are an entity that deals in selling equipment. In that case, it will no longer be called equipment, it will be your stock, because that is what you sell. But when it is considered equipment, it means it's the one you are using for your daily activities. So if your entity is specialized in the car manufacturing, so those equipment that are used to manufacture vehicles or parts of the vehicle are what you will call equipment. And when you are buying equipment, you are buying for the long term and for the investment. You are trying to invest in your business. So just there, you will realize that equipment falls under investing activities. So this negative will fall under investment activities, 40,000. So basically, I was just illustrating. Can we go to an example? Can we go to an example? An example. An example. An example. Okay. I hope this will be as clear as day. We have been given a question here. For example, assume Mikkel company reported the following for its most recent fiscal year. So you have the net income, you have your depreciation, you have increase in account receivable, decrease in merchandise inventory, increase in prepaid expenses, decrease in account payable, increase in wages payable, loss on sale of equipment. So these are entries. And basically when you are writing your cash flow, the first entry has to be your income, either profit, your operating profit or your net profit, depending on what you are given in the question. They will give you a financial statement of position, yeah, your balance sheet. That is a must. You will have to be given a balance sheet. Then in some instances, you will be given an income statement. Sometimes you will not. You will have to establish the net income or the operating profit. But you will always be given a financial statement of position, which is the balance sheet, and you will be given two comparable years. So maybe 2005 and 2006, 2010 and 2011, years that you will be able to compare. Okay. So we are saying that income is the first entry. Then you begin to identify your operating activities. Just as the illustration was given here in that order, that your activities, your operating activities come first, investment activities come second, financing activities come third. In this case, you are looking at your operating, after putting the net income, you are looking at your operating activities. Now, there are certain things you need to know, okay? So how each transaction, remember I said you need to be very careful about each transaction. Is this a monetary transaction? If it's not, what did you do to it in the income statement? Did you subtract it? So if you left from your profit that transaction, when it was a non-monetary value transaction, you need to add it back. Okay? You need to add it back. In this case, depreciation, we know that depreciation is a non-monetary value. But it is here. And we are being told there was a depreciation expense of that. So you know that in the income statement, this was less. So if it was less, you need to add it back to the income. Increase in account receivable. Receivables, what are receivables? Receivables are debtors, or money, things you've given people on credit and they are yet to give you. All right? So they owe you. And if they owe you, that account having those debts is called an account. And obviously they are short-term debts. So they short-term meaning they fall either 6 months or a year, under a year. So they are the ones. Now, if you are owing people, or they owe you, meaning they are having your money. So if you increase your account receivables, meaning you are giving people more money to hold to, meaning you are removing money from your business. And if that is so, you are reducing your money, meaning you have to less. When there's an increase in receivable or account receivable, you are lessing in your cash account because you've removed money from your business and you've lent it to people through goods or stock or your inventory, or through your inventory, whatever means you are doing that. Okay, so basically this was the first video of a series of under cash flow.